Welcome back. In part 2, we're following the chain beyond oil and stocks into the deeper layers of the global financial system. Now let us talk about bonds. Many beginners ignore the bond market. That is a mistake. If oil pushes inflation expectations higher, investors may expect fewer or slower interest rate cuts. That can push bond yields higher, and bond prices generally move in the opposite direction from yields. So even if you never trade oil, an oil shock can still reach your portfolio. Then there is gold. Geopolitical uncertainty can increase demand for traditional safe haven assets. Gold is one of them. But do not make the mistake of thinking a war automatically means gold goes higher. Gold also reacts to interest rates, real yields, the US dollar, inflation expectations, and investor demand. Now let's talk about Bitcoin. Some investors call Bitcoin digital gold. But geopolitical crises give us a chance to test that idea. When investors become afraid, will they buy Bitcoin? Or will they sell risky assets and move toward cash, gold, or government bonds? That is why crypto investors should not assume geopolitical crisis equals Bitcoin goes up. There is another important lesson for crypto investors. The blockchain may be decentralized, but the businesses around crypto are different. Exchanges, custodians, payment companies, and other financial intermediaries can still be subject to regulation and sanctions. The US Treasury has already targeted Iranian-linked digital asset exchanges and financial networks as part of its sanctions enforcement. Now there is another major piece of this story: China. Reuters reports that China buys more than 80% of Iran's shipped oil. That makes China extremely important. Because if Washington increases pressure on Iranian oil buyers, China becomes one of the biggest variables in the entire story. If you are an investor watching this situation, watch these 7 things. First, oil. Second, Hormuz. Third, China. Fourth, inflation. Fifth, Treasury yields. Sixth, gold. And seventh, Bitcoin. So when you see a headline about sanctions, do not immediately think buy, do not immediately think sell. Ask, what changed? Which market gets hit first? Does it affect supply? Does it affect inflation? How could interest rates respond? And which assets are actually exposed? Because that is how financial markets work. The shock starts somewhere and the consequences travel. So the Iran story is not just about Iran. It is about energy, trade, financial systems, inflation, interest rates, and your portfolio. Remember, the headline tells you what happened, but the chain tells you where the money goes. Follow the money, stay dangerous, stay invested. Market commentary only, not personalized investment advice. Past performance does not guarantee future results. Manage your own risk.